For the most part, the S&P was fairly mixed yesterday, but what did catch our attention was that both Visa and Mastercard were down again around 5% each, and that doesn't really have much to do with what we're seeing on a wider scale. As we note, investor sentiment now sitting in neutral. We even have an article here from the Wall Street Journal that Donald Trump has privately approved the attack plans for Iran, but that isn't something he has given the go-ahead as of now. And we also notice the Fed, in fact, did hold rates yesterday, although that was pretty much expected by the market. So in today's episode, we're going to understand, and in particular, why over the last week, not the market in terms of the red that we're seeing, but why are both Visa and Mastercard down around 9%, something that is very rare for two very high quality companies, and we're going to give you our own thoughts, valuation, as well as understanding whether we should be buying these companies right now and the margin of safety that we are seeing. What's also interesting to note is that analysts believe it is a great opportunity to buy. We have Barclays reiterate that this company will outperform, and this is amid the issues that we are going to cover shortly around stablecoin and the fears that they will really hurt the top line for both Mastercard as well as Visa. We get another analyst, but this time for Visa stock, saying that they still believe it is a buy, and again, that is amidst the concerns that the wider market has clearly shown given the drops we are seeing in the price. Now, we also want to reflect on institutions because they don't seem to be bothered about the company, at least over the last few weeks. We get institutional ownership at 82% for Visa, whilst they sold 37 billion worth of shares. We know they bought a lot more at 52 billion, and in the most recent quarter, they bought 60% more, 16 billion buying, 10 billion selling, and this is also reflected for Mastercard, 97% institutional ownership, whilst they sold 27 billion, again they bought a lot more at 48, and we also notice 3 times as much buying in the most recent quarter. So we're going to get on to why the company is in fact dropping, but what we're really pointing out here is that institutions continue to buy, analysts continue to believe it is a very good case for a buy the dip scenario, and also worth highlighting that super investors love both companies. Visa, for example, 24 super investors hold it within their own portfolio, and we get a fairly large buy by one, just under 1 million shares, adding around 7% of Visa to their overall portfolio composition. And Mastercard, while slightly lower in terms of ownership count, still 16 super investors hold this company, but we do get a little bit of trimming, but also some very marginal buying. Now, if we just have a quick look at Visa in terms of their performance, over the last year, it's up 24%, year to date, it's up around 8%, and over the last 10 years, it has, as we will come to show you, massively outperformed the S&P, up nearly 400%. Is also one that trades at the upper end of the 52-week range, and we only get one buy rating from Wall Street with a hold from Seeking Alpha and Quant, although not far off the 3.5 that would flip them into a buy, and we're going to run through the valuation after we do discuss the reason for the fall. Mastercard, on the other hand, up 20% over the last year, year to date up 2%, over the last 10 years, another massive outperform of the S&P, trading at the upper end of the 52-week range. However, we notice a double buy. This also includes not just Wall Street, but Seeking Alpha as well. We get an article from Bloomberg who actually said after the first drop we saw, not the one yesterday, that this dip is definitely a very strong buying opportunity. So given we are now noticing another drop, this, in their eyes, looks to be a golden opportunity. Now, we covered this a few days ago when discussing the company, so we are going to take a look at a bit more information. But ultimately, Walmart and Amazon, and now, as we'll come to show you, many more companies are exploring issuing their own stablecoins, which, as we can see from the share price down nearly 10% in just a matter of days, has got investors in both companies very worried and potentially take away payments activity from the banks and the traditional system we have in place. Now, one of the benefits to companies like Walmart and Amazon doing this is that they will save billions of dollars in fees, which is very good, not just in fact for the company, but also shareholders of companies that are very similar, as we can also see Expedia Group, another company that is considering, but it doesn't stop there. We'll also show you later on that Uber, Airbnb are also thinking about the same thing, as well as some surprising names. And these stablecoins effectively at the moment are used just to store cash, but you can also use it to buy cryptocurrency tokens, which probably does scare a lot of investors and even consumers at the moment, because the traditional banking system has been put in play for so long and the security does look to be good. But the real key benefit here is for the companies that could save a massive amount of money, and you would expect to pass on some of this excess cash that they get from their savings onto the investors. And whilst we have heard from some different payment alternatives over the years, they have really failed to gain traction. This has now changed as the Senate did pass the bill, and some of the issues we need to consider for both Mastercard and Visa is that ultimately it does threaten their dominance in payments. They make billions by acting as intermediaries in global transactions, and a cryptocurrency bill that legitimizes crypto means we're one step closer to people and businesses using blockchain networks and sending money directly without needing the middlemen like Visa and Mastercard. Also worth highlighting, the lower fees, as we stated, will help companies like Amazon save a significant amount of money, and this will eat into Visa's and Mastercard's core business. And we also have Circle, the issuer of USDC, which is one of the largest stablecoins, surged massively after the Senate cleared this path for the stablecoin regulation. Now this is a big deal because stablecoins like USDC are designed for fast, low-cost payments that don't need a credit card network, and now they're on the brink of effectively going mainstream. And we can see in just the last 5 days they're up 78%. In fact, just yesterday alone they're up 34%. And for Visa and Mastercard, this is a direct challenge. Companies built their empires on payment rails that take a cut of every transaction, but if stablecoins become regulated and widely adopted, merchants and consumers could start bypassing the legacy system entirely, meaning less volume, lower fees, and a potential long-term threat to their dominance. And we also have JPMorgan filing a blockchain-related trademark, triggering speculation about a stablecoin, and not long after, they officially move forward with a new digital token called JPMD, essentially a JPMorgan-backed stablecoin. Now this is massive, not just for crypto, but for the legacy payment players, Visa and Mastercard. If the biggest bank in the US is developing its own blockchain-based payment system, they're not doing it to play around, they're doing it because of the economics of blockchain, faster settlements, fewer intermediaries, and lower fees. Now imagine this, major institutions like JPMorgan start moving money across their own token rails, merchants adopt stablecoins like JPMD or USDC, payments become instant, nearly free, and that is a huge threat to Visa and Mastercard. Now these networks do thrive by charging a cut of every transaction, but blockchain infrastructure could cut them out entirely, or at the very least force a race to the bottom on fees. Now let's quickly break down how these companies in fact actually make money, because most people think they issue your credit card. They actually don't. They don't even lend money, they don't hold your balance, and they're not the ones charging you interest. That is the jobs of the bank. What Visa and Mastercard do is run the payment network, the pipes that connect your bank, the merchant, and everyone in between. So every time you tap your card, buy something online, both Visa and Mastercard take a small cut of that transaction, usually around 1 to 3%. Multiply that by billions of transactions a day right across the world, and you can see why they're the two of the most profitable companies in the world. But this is the catch. Their entire business depends on being the middleman. So when you hear that the Senate is legitimizing stablecoins, or that Circle and JPMorgan are launching their own blockchain-based payment system, that is a direct threat. Now that is ultimately because crypto and stablecoins allow money to move instantly, 24/7 for a fraction of the cost, without needing Visa or Mastercard's rails. So if big banks, fintechs, or even governments start embracing these systems, Visa and Mastercard's role in global payments start to shrink. Now they have had a near monopoly for decades, but this wave of crypto regulation and innovation could chip away at their moat, one transaction at a time. Now, given the drops these companies have had, we just want to talk about the valuation. Firstly, starting with Visa, their forward P of 28.3 isn't dissimilar from their 5-year average of 27.6, so we would call this a reasonable signal. Bear in mind, we're not looking at any of these models in pure isolation. We will run it through our discounted cash flow shortly, and based on yield as well of 0.69, not far off 0.73, another, as we would say, reasonable signal. Now, the other method we have here before the DCF is looking at the blue tunnel, which does in fact give us the intrinsic price. We also note again it is pretty much firmly sitting in the parameters, so another reasonable valuation. If we were to zoom out over the last 5 years, you can see some areas where in fact it sits below. That is severe undervaluation, not something we have seen in quite some time, or in fact in 2025, so something we will keep our eye on, especially if this price does continue to dip. Now, if we do the exact same with Mastercard, we pretty much get the exact same conclusion. Forward P not dissimilar from the 5-year average, the same to be said about the yield, so another reasonable valuation, one that is also confirmed when we take a look at this model. And over the last 5 years, the last time we really got severe undervaluation was towards the end of 2023. Now, Visa or Mastercard, which is ultimately the better quality company, and we'll reflect that when we look at the underlying metrics, starting off with Visa and their free cash flow payout below 60% every single year, pretty much around 20%, 21 on a trailing 12 month. So no surprises, this company, whilst we haven't covered it today, does increase historically their dividend at a double-digit rate. Free cash flow per share also increasing the way we want to see, consistent for the large part year on year, expected to go up over the next 12 months. Sales growth as well, bar the COVID drop, which is justifiable. We do notice, in fact, the majority sitting double digit, 10% in 2024. And then we look at their total sales, where they've nearly tripled their top line, as well as returned excess cash to investor pockets through those share buybacks, something we always love to see. ROIC phenomenal as well, well above the minimum 10%, to give us faith management are able to effectively allocate their capital, sitting at 31 on a trailing 12 month. And then margins fantastic as well, something you would expect both on the operating side as well as the free cash flow, truly a free cash flow machine. Then the final metric here is the net debt to EBITDA, which is incredibly low. These are the number of years it would take the company to pay off all of their debt net of cash on hand, well below 3, correlates to balance sheet strength, indicating very strong. If we then do the same on Mastercard, we can in fact see, again, free cash flow payout very low, around the 20% consistently. Another company with pretty much double-digit increases to their dividend. Free cash flow, again, consistent year on year, expected to continue over the next 12 months. Sales growth, again, we're seeing a lot of similarities, double-digit for the large part, and they've also pretty much tripled their top line while returning excess cash through those share buybacks. In terms of ROIC, very good, a little bit higher than what we noted from Visa. Nonetheless, both of them with some attractive numbers, and margins, no surprises, especially given the business model, looking strong on the operating and free cash flow margin. Finally, net debt to EBITDA, as we said with Visa, very strong balance sheet, no issues whatsoever. Now, in terms of the growth, this is quite important because when we come to the valuation, we are going to use a higher growth rate moving forwards for Mastercard, but we can see for Visa, we notice a B, revenue year on year, 10%, as well as forward looking, above the sector comparative in the mid-single digit, and we also notice pretty much growing their top line as they have done over the last 5 years, and EPS projected over the next 3 to 5 years, 13%, above the sector at 10, but slower than their 5-year at 16. In terms of Mastercard, they also get a B, where we notice revenue growing a little bit faster, 13 and 12%. That is also above the sector comparative, and also they're growing slightly faster than they have done, or thereabouts, from the 5-year average. EPS projected 14%, well above the sector at 10 again, but quite some way below the historical at 20. Now, profitability is going to be very strong on both accounts. Visa at the A+, 98%, well above the sector, pretty much in line with their 5-year average. Bottom line, 53%. That is very high. You're not going to see that common, in fact, on the channel when we uncover companies. Sector a lot lower, and they're slightly more profitable than their historical average. They also generate 22 billion cash from operations, sector nowhere near at 155 million, and an improvement from 17 on the 5-year. Likewise, Mastercard A+, gross margin 100%, pretty much what we have noticed year on year, absolutely phenomenal. Net income margin 45%, we also notice a little bit higher than their 5-year average, and the cash generated from operations 15.5 billion, very high at 50% more than their historical. Now, we also quite like to see how do they compare against the S&P in terms of performance. We've said they're high quality, so surely they should outperform. And over the last year, the S&P is up 9%, nowhere near Mastercard and Visa, where we see 25 and 20% for Visa and Mastercard respectively. When we expand to the last 5 years, we actually see the S&P marginally outperform at 92%, where both Mastercard and Visa sit around the 82% level. And then when we zoom out to the last 10 years, this is where we really see the companies move forwards. S&P up 186, Mastercard up 506, Visa up 431. So yes, Visa has massively outperformed, but we see Mastercard slightly with the edge at 506. Now finally, before we get into the valuation, we want to see expectations moving forwards. For Visa, the next 4 quarters, every single one, double-digit growth to the earnings per share, whilst also having a 100% track record of being either in line or outperforming expectations. And we can see they're trading on their next full accounting period at a forward P of 27. Likewise, when we look at Mastercard, no surprise then, green right across the board, although we don't get the double-digit expectation, only 2 of the next 4, and we can see trading at a forward P that is higher than Visa at 29 on 26 numbers. Now, just before we jump into the valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of June. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet released just yesterday running through stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now starting off with Visa, we have the intrinsic price at $379 derived from the DCF model, where we have the average at 17% over the last 10 years. Now moving forwards, we have gone for 10%, as you can see, low, medium and high, 8, 10, 12 respectively, but as always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Visa or any others, but at 10% and the discount rate at 8, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 379, indicating 11% upside. Now you may believe that is too high, you see this as a real threat to the company, and you see 8% as more reasonable, then intrinsically 328, overvaluation, downside of 4%. You may think the opposite, you believe we've gone too low, a lot more conservative than maybe you would want to see, 12%, 437, indicating 29% upside. As typical on the channel, we take through the middle rate at 10%, where we're not done because we apply a margin of safety. 10% execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for Visa, now after the drop we saw yesterday, you're getting a 10% MOS, so it could be one to consider if you see it meeting the 3 golden criteria. We do believe a very high quality company. Wall Street themselves see 405 over the next year, upside translating to 19%. Now look, for those that like it but want a larger MOS, at 15%, a buy at 322, at 20, a buy at 303, and at 25, 284. As we said though, it only has 10% as of now. Wall Street themselves, a 19% upside. Give us your thoughts on Visa, buy, hold or sell. We then move on to Mastercard, where we get an intrinsic price of $544, and we can in fact see we have used a high growth rate at 12%, which you could argue to be reasonable given we saw it outperforming in those metrics earlier in the episode. And at the 12%, we actually see only 1% upside, which pretty much tells us if you're buying the company now, already baked into the numbers is 12% growth to the future free cash flows. If you believe it should be lower at the 10% point, then intrinsically much lower at 470, downside of 13. And if you believe it should be 14, which is in fact still lower than the average over the last 10 years, most recent year was 25%, then 628, 17% upside. Now taking the middle rate, again we like to be consistent, you are getting a margin of safety, although it is very small and isn't even at the 5% point, you would need to wait for 517. So Mastercard, unlike Visa, has no margin of safety. Wall Street, however, see upside of 19%, around $640 into 2026. Now, for those that want to see at 10%, a buy at 490, at 15, 462, at 20, 435, and at 25, 408. Give us your thoughts. Which one do you prefer? Mastercard does look like more of a growth play, but no margin of safety, whereas Visa does look more attractively valued, 10%, both of them fairly similar upside. Let us know your thoughts, as well as Mastercard a buy, hold, or sell. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.